In every economic storm, there's always one universal instinct: run to safety. And when fear spreads faster than interest rates rise, money stops trusting promises and starts trusting metal. Welcome back to FluxFolio Finance, where we decode the movements of money, markets, and the forces shaping your financial future. Today, we're talking about one of the biggest comebacks in modern markets: the explosive rise of precious metals. Gold hitting record highs, silver tripling in price, platinum and palladium rebounding from multi-year lows. But the real question is, why now? And can silver, the metal once used for everyday coins, really outshine gold in the years ahead? Let's dig in. The surge nobody saw coming from the start of 2025, gold prices doubled, climbing from around $2,000 to more than $400 per ounce, shattering all-time highs. Silver, meanwhile, did what silver does best: amplify the move. It tripled, piercing through 51 per ounce within months. At first glance, the headlines read like simple demand and supply stories: central banks hoarding bullion, investors hedging against inflation, miners struggling to keep up. But this rally isn't just about scarcity, it's about fear. When Moody's downgraded US sovereign credit in May 2025, as we covered in our previous episode, it shattered a century-long illusion that treasuries were risk-free. That downgrade sparked a flight out of bonds, a shakeout in currencies, and a new wave of demand for hard assets. Gold, the ultimate monetary metal, became the anchor. Silver, the volatile younger sibling, became the amplifier. The gold-silver ratio, the market's hidden compass. If you want to understand silver's explosive potential, you have to understand its mirror image, the gold-silver ratio. This ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, the ratio's long-term average hovers around 60 to 70. When the ratio is higher, say above 80 or 100, it means silver is cheap relative to gold. When it falls below 50, silver is outperforming. Before the 2008 crisis, the ratio hovered around 60. During the crash, as investors panicked into gold, the ratio spiked above 80. But after the crisis, when stimulus flooded markets, silver roared. The ratio collapsed to around 30, and silver prices soared past $45 per ounce. Fast forward to today. Just months ago, the ratio touched 100 again, signaling massive undervaluation. And as gold broke to new highs, silver started catching up, compressing that ratio back towards 60. That's not coincidence, it's history repeating. Because silver almost always lags gold at first, then outperforms in the aftermath. Why silver moves the way it does? So why does silver behave like this? Unlike gold, which is almost purely a monetary asset, silver wears two hats. It's both money and metal. Roughly half of global silver demand comes from industrial use: electronics, solar panels, batteries, medical technology, and now the booming clean energy sector. That dual nature is silver's gift and its curse. In calm times, investors ignore it as just another commodity. But when monetary fear and industrial optimism collide, silver explodes. Today, those two forces are converging perfectly. Inflation is sticky, currencies are wobbling, and global demand for solar and green tech is at record highs. Every solar panel needs silver, about 20 grams per unit. As renewable installations surge worldwide, industrial silver demand is projected to hit 1.2 billion ounces this year, the highest in history. At the same time, mine supply has been falling for 3 consecutive years. Mexico, Peru, and China, the top producers, are all reporting output declines. That imbalance means even small investment inflows can send prices flying. Can silver outperform gold again? The short answer, yes, and violently so. In previous cycles, when the gold-silver ratio broke down from extreme highs, silver's outperformance was dramatic. From 2009 to 2011, silver gained over 400%, while gold rose about 150%. A similar move today, with gold targeting $5,000, could push silver toward $100 or even $150 per ounce. But let's be clear, silver isn't just riding gold's coattails. It's also benefiting from something deeper, the trust crisis in fiat money. As countries diversify reserves away from dollars, central banks have been buying gold at record pace, over 1,100 tons in 2024, according to the World Gold Council. But smaller investors, unable to buy tons of bullion, are turning to silver as the people's hedge. Silver is effectively becoming retail gold. And that's powerful, because when small investors, institutions, and industries all chase the same scarce metal, liquidity thins, and volatility spikes. The volatility traps silver's strength is also its danger. Its market capitalization, about $2.8 trillion, is tiny compared to gold's $30 trillion. That means less liquidity, fewer buffers, and sharper price swings. A billion-dollar inflow barely ripples gold, but it can send silver prices up 10% overnight. That's why silver's rallies are explosive, and its crashes brutal. When gold corrects 5%, silver might drop 15%. In 2020, during the pandemic panic, silver plunged from 18 to 12s, a 30% wipeout, before roaring back to 30 within months. It's a trader's dream and a long-term investor's roller coaster. So if silver's rising faster than gold, it's not just optimism, it's leverage. Leverage built on volatility, liquidity, and emotion. Beyond silver, other precious metals in play. Silver might be the headline act, but it's not alone. The broader precious metals complex is waking up after years of neglect. Platinum, with a market cap of around $400 billion, is benefiting from renewed industrial demand, especially in hydrogen fuel cells, automotive catalysts, and jewelry. Production is heavily concentrated in South Africa, where power shortages and labor strikes are tightening supply. If hydrogen technology gains traction, platinum could see a secular bull market, possibly doubling from its current 1,100 to 2,200 per ounce levels. Palladium, once the darling of the automotive sector, remains volatile. It's essential for gasoline catalytic converters, but the global shift toward EVs is curbing long-term demand. Still, geopolitical supply risks from Russia, the world's top producer, keep its price floor high, around $1,000 per ounce. And then there's bronze, not a precious metal in the strict sense, but an industrial barometer. As an alloy of copper and tin, bronze tracks global construction, manufacturing, and electrical demand. When bronze prices rise alongside silver and gold, it signals something bigger. systemic inflation. It means raw materials, industry, and money are all heating up at once. Inflation, fear, and the future. Here's the big picture. When all precious metals rise together, gold, silver, platinum, palladium, it's not a coincidence. It's a warning. Because precious metals don't just reflect industrial cycles, they reflect confidence cycles. They rise when faith in paper money falls, when inflation lingers, when debt balloons, when geopolitics unravel. And right now, all three are converging. Global debt has passed $330 trillion. Inflation in major economies remains above 3%, even after years of tightening. And wars, sanctions, and trade fractures are redrawing the map of resource flows. The world isn't running out of metal. It's running out of trust. That's why gold's at record highs. That's why silver's tripled. That's why investors are asking, what's next? What comes after the silver boom? If the current trajectory continues, with gold targeting $5,000 and the gold/silver ratio sliding toward 40 to 50, silver could easily test $80 to $120 per ounce within the next year. Some ultra-bullish projections stretch even higher, $200 per ounce, if inflation spirals or a liquidity crisis erupts. But remember, markets move in waves. Each bull run breeds overconfidence before the next correction. The key is to understand that this is not a temporary rally. It's part of a larger monetary shift. As the dollar's dominance wobbles, and as digital assets like Bitcoin rise in parallel, metals are reclaiming their ancient role, the tangible anchors of value in an intangible world. Gold remains the institutional hedge. Silver is the high beta bet. Platinum and palladium are the industrial plays. Together, they form the new barometer of global uncertainty. The sound of metal, the weight of truth. In every financial cycle, paper wealth expands until it collides with physical reality. That's when metals remind us what's real. Silver's surge isn't just a chart pattern, it's a symptom. A reflection of a world drowning in liquidity, but starving for solidity. And while it may wobble, crash, and soar again, its message remains the same. In times of doubt, trust the elements that last. Thanks for watching FluxFolio Finance. If you found this breakdown insightful, hit like, subscribe, and drop a comment. Will silver truly outperform gold this cycle, or is this just the calm before another storm? Stay sharp. Stay curious. And remember, wealth isn't just what you own. It's what endures when everything else burns away.